All right, welcome. Today, we are going to pull back the curtain on one of the most powerful tools in a trader's toolkit, support and resistance. We're going to take what looks like pure chaos and show you how to read it like a secret language.
Okay, so let's just dive right in. You look at a stock chart for the first time, right? And what do you see? It's just this chaotic mess of squiggly lines going up and down. It feels totally random. But the real question is it? Or are there actual predictable patterns hiding in all that noise? And that really brings us to the core idea here. There's this great quote that says, "The market's simplicity is its greatest disguise." And it's so true. Underneath all that seeming complexity, there are these surprisingly simple principles at work. You just have to learn how to see them. So, let's get started by learning that hidden language. We're going to break down the basic vocabulary, the ABCs, that will help you read the story that every chart is trying to tell you. Think about it like this. Every single tick up or down on that chart, it's not random. It's the outcome of a constant auction. It's this epic tug-of-war between the buyers, who are trying to pull the price up, and the sellers, who are trying to yank it back down. Understanding this battle, well, that's the key to everything.
So how does this battle actually look on a chart? The easiest way to visualize it is to imagine a ball bouncing in a room. It hits the floor and bounces up, right? Then it hits the ceiling and comes back down. The market, in a lot of ways, works just like that.
So, let's talk about support. That's the floor. It's a price level where buyers start to see a lot of value. They think, hey, this is a good deal. So they step in, and their demand starts to outweigh all the supply from the sellers. And just like that bouncing ball, boing, the price tends to bounce back up.
And on the flip side, you've got resistance. And you probably guessed it, that's the ceiling. This is the point where sellers start thinking the price is getting a little too high, and it's a great time to take some profits. They start selling, supply floods the market, and boom, the price gets pushed back down. And this comparison just lays it all out so clearly. At support, the floor, you've got more demand than supply. The buyers are in control. At resistance, the ceiling, it's the total opposite. Supply is bigger than demand, and the sellers are running the show. It's really that simple push and pull. Okay, so we get the idea of floors and ceilings, but how in the world do you actually spot them on a real live chart? Well, that's where we learn to listen to the bounces by recognizing some very specific patterns.
You can really think of these patterns as the market's body language. When a price tries over and over again to break through a ceiling or smash through a floor, and it fails, it leaves behind a visible shape. It's a clue. It's telling you about the strength of that level and maybe where the price is headed next.
A classic example of this is the head and shoulders pattern. It's basically the story of a rally that's running out of steam. You see the first attempt to break out, that's the left shoulder. Then a second, higher attempt, that's the head. But the third try is weaker, it's the right shoulder. And when the price finally gives up and breaks below that support level, the neckline, that's a huge signal that the trend might be reversing.
So you see the theme here, right? Whether it's 2 failed attempts to break a ceiling, like a double top, or 3 failed attempts, like a head and shoulders, these patterns are all telling you pretty much the same story. The momentum is fading and things might be about to change.
Now, spotting these levels is one thing, and it's pretty cool. But the real question is, so what? How can you actually use this information? Let's talk about turning all this theory into a practical strategy.
Right, exactly. How do traders put this into practice? Well, they use these floors and ceilings to help them make much smarter decisions about when to get into a trade and, just as importantly, when to get out. It's all about managing risk based on these predictable bounce points.
And the basic logic here is really straightforward. When the price comes down and starts bouncing off that support floor, a swing trader might see that as a green light, a good opportunity to buy because they're anticipating a move back up. And on the other hand, when it hits that resistance ceiling, they might look to sell, expecting the price to head back down.
But, that ball doesn't always bounce between the floor and the ceiling. Sometimes it smashes right through one of them. And that, my friends, is called a breakout. This is where things get really, really exciting.
A breakout is a really powerful move. It's a signal that the old agreement between buyers and sellers is officially over. One side has won the battle, and they've won decisively. This often kicks off a brand new, very strong trend in that direction.
But, and this is a huge but, how do you know if a breakout is the real deal or just a fake out? Well, the number one clue, the most important piece of evidence, is a big surge in trading volume. A breakout that happens on low volume, that's like a shout without a voice. It usually doesn't have any real conviction behind it. So just picture this in your mind. The price is pushing up towards that old resistance ceiling. But this time, instead of turning back, it just blasts right through it. And as it does, you see this massive spike in volume on your chart. The sellers just got totally overwhelmed. The buyers are now in complete control.
And here is the really cool part. This is the wow moment. That old ceiling, the level that used to be a roadblock stopping the price from going higher, it now has a completely new job. It becomes the new support floor. It acts as a foundation for the price to potentially climb even higher from there. This role reversal is an absolutely critical concept to grasp.
Okay, so as we start to wrap this up, it is so important to remember this. Support and resistance is not a crystal ball. It is not going to predict the future with 100% certainty. Think of it more like a blueprint of the market's structure. It shows you where the key battlegrounds are likely to be.
So, let's just do a super quick recap. The key takeaways. Support is the floor. That's where the buyers are strong. Resistance is the ceiling. That's where sellers take over. Those chart patterns we talked about, they signal the strength of those levels. Volume confirms everything, especially breakouts. And don't forget that powerful idea that old ceilings can become new floors.
You know, when we started this, you might have looked at a chart and just seen chaos, but now you can see the blueprint underneath it all. You can see the floors, the ceilings, and the whole story of the battle between buyers and sellers. So the only question left is, now that you have the blueprint, what are you going to build with it?